Good morning, everybody. It is September 22nd. This is the Macro Dashes webinar, and we will talk a little bit about the market, given that our buddy, Jerome Powell, threw up his hands yesterday and said, hey, let's have a recession. You know that I don't believe that we need a recession. Apparently, JPOW thinks otherwise. Why do I disagree with the Fed being so aggressive? It's because all the leading indicators already say that the economy is turning over, and to keep it from really plunging is going to be a trick. So I don't know that I believe all the hawkish talk that the Fed came out with yesterday. Remember last week I told you that he was going to have to talk the market down, and he's trying really hard, and they ended up increasing the quantitative tightening, which I wasn't so sure they would have done a few months ago, but they're doing it. So we'll be going into the second month of quantitative tightening at $95 billion a month in October. In the past, when they tried quantitative tightening, it really was only the one time, it ushered in a 2-year sideways stock market. Choppy, but in the end, sideways, 2014 to 2016. Could that happen again? It could. That would probably be the healthiest thing, and that would allow the winners and losers to separate, but have the indexes not get crushed. However, if the Fed can't stick the soft landing, and it's really beginning to look like they can't, I thought they could, but I'm not so sure anymore. If he stays this hawkish in November and December, man, first half of next year could be horrible. I really didn't plan. I really didn't expect that would be the route that the Federal Reserve would go. Now we're getting very close in real time to whether they jump the shark on interest rates and quantitative tightening, or if they do in fact pause at some point in the near future. The next meeting is the first week of November, first and second, or second and third. I have to double check. And if he goes forward with another 50 or 75 basis point raise in the interest rate, man, that would be like hitting the economy with a sledgehammer at that point, because we already know that the leading economic indicators are falling. In the last article I wrote on the public side, there were a lot of comments that basically asked, what indicators are you looking at? Well, gee whiz, leading economic indicators is a thing. So this is the headline. Leading economic indicators fell even further in August. Those indicators are right here: earnings, ISM, building permits, things like that. So I'd encourage you to go to the Conference Board website, because it is a wealth of information. Here's what we see. Leading economic indicators are turning over, and they're turning over pretty quick. The coincident indicators are flattening out. What the Federal Reserve needs to do is get this to drop, but not drop below 100, and for this to flatten out. Can they do it? Maybe. I think they have to pause in November, maybe only do 25 basis points like Jeffrey Gundlach suggested. Between now and then, that would allow the stock market to correct, retest the bottom, maybe set a new bottom, and that would give the Fed cover to back off a couple of days before the election. Almost too perfect. We'll see. We are at extremely elevated risk of a recession. We've already gotten the signal. It's not a good trend. How do they get that to go like that? How do they get it to stop plunging? I think it has to be a pause. I think it has to be November 1st and 2nd. If they raise again, really anything more than a quarter point, I just think we get a horrible fourth quarter rather than stabilizing and then entering into a new bull market in January, which has been my base case. So when you take a look at this website, you want to go through the different data points that they have on here. So go to data, and you can pull up quite a number of things. And I like to look at the global data. And what you see is there's very little strong growth around the world. Really, there's no strong growth around the world. And a lot of economies are starting to take a step backwards. Australia is virtually always positive. Look how close they are to zero. That's pretty low. Brazil making some money on oil, but they're even below 1%. So when you take a look at the potential for global recession, you can go through all the different things that they have here. And the recession tracking is pretty telling. Leading economic indicators are heading down. GDP growth is almost non-existent. If you go over to the OECD data sets, another good website for you to take a look at once in a while. I'm going to be writing the macro dashes later today and including a lot of this data. But look, this is pretty clear, right? pretty clear that this is turning over globally. The cost of production for goods, PPI, is already negative. So the price of making stuff is going down. Services barely moved up in August. ISM manufacturing index is turning over. If it gets down to 50, that's very recessionary. So it's getting close again. You should be able to see that we're within just a few months of a lot of what should be cyclical corrections, cyclical bear markets, pauses, the type of skip straight recession that I've been talking about, the periodic bad quarter, is usually what? The first quarter. So I think they're going to beat inflation soon. It's just a matter of what do they try to do to the economy and the stock market over the next quarter or two. I really can't see them raising at all in December, especially if they do a half a point in November. So maybe that will be the nail. But what I want you to focus on is that we're getting close to the end of this tightening. We have to be, because trying to flatten out demand is one thing. But with higher interest rates, that makes it hard to develop energy and to move the supply chains. They have to flatten out demand without beating up the supply side. It's going to be very delicate. I think the Fed is one step away from a major mistake. I understand the psychology of them trying to get the stock market to correct to near fair value. The problem is the stock market doesn't always cooperate. There's a lot of trader narratives make the stock market do dumb things. Now, we do know that liquidity, and I'll put that in the article as well, we do know that liquidity is drying up. Goldman Sachs tracks that. So that means there should be some pretty big moves to the downside in the stock market. And then once we get a capitulation week, you could see some very big moves up. So if you're an investor, I hope that you already are holding a lot of cash, because in that capitulation week, you're going to be able to put a lot of it to work, maybe all of it. You need to prepare yourself emotionally right now to take some bigger bites when we get this or we get this. We're even seeing copper turnover, even though the long-term outlook for copper is spectacular. Why is it spectacular? Because with the decarbonization of the economy, we're going to need a lot more copper, cobalt, nickel, lithium, silicon. Some of those things are hard to mine. Others are hard to process. Copper is hard to mine. We're probably at global capacity in 2024, 2025, and it takes almost a decade to develop a new mine. We're going to have to make up the difference through recycling, which we actually have the metal to recycle. We just don't do it. So in the next few years, I would imagine that there's some pretty big development in copper recycling, because that's easier to do than dig a new hole in the ground. So if you know of any great investments, companies that are moving into copper recycling, let me know. Because if they're public, or if we can get them through private equity, those are probably going to do spectacularly well for the next decade or longer. The surpluses that we have in the economy pretty much are at the end goods part of the economy. There's stores and even Amazon with a lot of inventory. So you should see some pretty huge opportunities to do some great Christmas shopping pretty soon, or any whichever holiday is yours. Once that inventory is soaked up, we might have a little shortage of toilet paper again in the winter. Not just kidding. But I would imagine that the first quarter of next year is going to be a restocking period. So we might see a number of weeks in the first quarter where there's a little bit of scarcity for end products. And that's not atypical. And the stock market will see that tightness and anticipate it. So I'm still thinking that next year is a big up year. I don't know where the bottom is this year. I thought it would be the first or second week of December, but I can see that moving up to the last week or two of October. Not saying things are manipulated. However, it would be interesting if the Fed got what it wants in the next 4 or 5 weeks, which would be the rest of the leading economic indicators turning down, inflation falling, unemployment ticking up, employment ticking down. All these indicators that are in here are pointing to that happening, but it's hard to pin it down to a month. Will it be September, October, November, December? I don't know, but we're really close. One of the things that we watch is timber. We do the all chart here over at TradingView. Goes way back. Look at that spike, right? Everybody's complaining about timber prices last year. What a collapse. And I told you it was coming. So look where we are now. We're down to a pretty significant place. Look at that. The spot where the timber market typically ran into big resistance, it's now at basically a support level. It's treating it like support. This area in here I think it's probably a pretty good price zone for timber. If it gets below the red line, which is basically its centering line for the very long term, probably is a bargain. Probably makes sense to just go buy a whole bunch of wood or futures. So here's what I think. I think that if you haven't accumulated cash already this year, I have a hard time telling you to do it now because so many things are beaten up. But if you still own zombie stocks, that you're in denial about being zombie stocks, if you still own an S&P 500 fund, that's where you can raise money. Because the big losers, again and again, I've told you this, and I know there's some new people on the line again, are the companies that are low growth or no growth, have CapEx that needs to be financed, and balance sheets that need to be refinanced. And we know a lot of them redid their financing last year and the year before because the Fed was so loose. And even the Fed was buying some bonds, corporate bonds through the ETFs, which pushed corporate borrowing rates very low, extremely low. This is the Fed starting to unwind that, but the maturities of most of that debt are the second half of this decade. So they have time to adjust. But if you take a look at Stock Rover and you take a look at the sectors and the companies that require financing for their CapEx, right? CapEx intensive companies that don't have a lot of pricing power nor a lot of growth. And there's a lot of them on the S&P 500. I've told you between 100 and 200, depending on how tight things get, that are in big trouble. QQQ, on the other hand, I think is rapidly becoming a huge bargain. I'll bring it back here to this little stealth bear market, this area in here, but could get all the way down to around 200 if we get into the zombie apocalypse zone. There we go. There we go. So you see where these lines are. There's a gap here in demand. So I actually think I'll move this down to here, move this down to here. Why? Why did I just do that? So what I'm doing here as a quant is just measuring the supply and demand of the shares. Where does big institutional buying come in? And it looks, there you go, more and more like it's one more zone lower. Then in here, you would just get massive support and probably a Fed put. That might be the easier thing to think about. This is the area where the Fed would probably step in. Now, do I think it's going to take until 2025 before we see lower interest rates? I don't know. I think we probably see lower interest rates in 2024. I think based on the presidential cycle, that's likely. And if they get this down into this price range, right, don't crash it. They get it down to, lower 200s on QQQ. Boy, oh boy, that seems to me to be quite the bargain. People who are betting against Google, Apple, Microsoft, NVIDIA, who did I miss? Microsoft, Apple, NVIDIA, Amazon, Google, right? 5 of the 6 man bag stocks are, to me, out of their minds. Those companies already got a minimum income tax slapped on them, which, they'll never pay 15%, but it'll be higher than the zeros and ones and twos they've been paying. Do you really think the government's going to go after them on the regulatory side? Europe squeezes them when they can because they don't have any good competition for them. That's their own fault. But you see what's happening to Facebook. Competitions come for them. Appetites have changed. It's not the shiny new thing anymore. iPhone is running into longer replacement cycles, so they have to replace that income with services, which they've successfully done. There's about to be even more consolidation in the streaming space as the growth continues, with linear TV disappearing faster and faster. Now, that's one of the reasons why I keep looking at Comcast and Warner Brothers and Paramount. There are parts of the economy, sectors, industries that are so beaten up that they're at that point now where asking how much more they can go down is the wrong question. The right question is, when this turns, how much can they go up and how fast can it happen? So when we're looking for investments, you have to keep your eye on the ball in real time. And if the knife is falling, you let it fall. I told you in both chat rooms today, put a pause on buying stuff because the Fed was more hawkish yesterday than I expected. I think it might be part of their psychological game. But if it's not, if he's super hawkish again November 1st and 2nd, man, oh man, then we get another horrible month. And I'm telling you, the next 4, 5, 6 weeks could be spectacularly bad. And if it is spectacularly bad, we need to take a look at the inflation data and the leading economic indicators. Because at November 1st and 2nd meeting, he has to make a decision on whether he wants to be this hawkish again. I can't imagine he would be, But again, they don't call me and say, hey, Kirk, this is what we're really doing. So we are at the eyeball stage. If he's hawkish again November 1st and 2nd, I will call that for what it is, maybe the biggest mistake in Fed history. But the scenario that I think is going to play out is that this super hawkish Fed did it because that was the hammer they needed. And they're going to pause or become less hawkish November 1st and 2nd. So what we have here is 4 or 5 weeks of the Fed hoping they get cover to back off because they know, like we do, that the first quarter is going to be kind of messed up anyway. And you don't want to see stagflation next year because we're already sort of, we're playing with it right now. The only thing that's saving us, I think, is a lot of people did revenge spending. A lot of people have what they need, in that top 20% or so of the economy financially. And if inflation comes down, that's good for everybody else. So a soft landing is possible. I think they have to be more dovish. And if they're not, wow, we could see those 2015-16 prices that I warned you about a year ago. But right now, this looks like the QQQ range, lower 200s. And you'll want to buy it because those companies, they're just going to keep gushing cash, great balance sheets, secular growth, low capex, high margins, and they're taking the hit to margins right now, right from the small tax increase. So I really think October, we're going to get those earnings revisions. The market's going to react horribly to that. And then the Fed has to decide what to do. On Monday, we'll talk about stocks. I've got a huge update on the stocks of the week that just keeps getting longer and longer. So I don't know. I might break it into components. All right. Any broad economic or ETF ideas or questions? Somebody asked, should we set our good till cancels below the June lows? Depends. Maybe somewhere. I mean, for sure on QQQ, right? And it's going through right now. It's setting new lows, which is what I said 2 weeks ago, 3 weeks ago. We're going to set lows or set new lows. So QQQ is going to set a new low for the last 52 weeks. SPY, which you shouldn't own, going through it right now. Our stocks, which are mostly mid cap right now, are different than these large cap indexes. Can they go lower? Sure. Where are they going to be in 5 years? So you should be thinking. Got a lot of puts probably getting put to us next couple of months. That's fine. We're going to be pretty close to the bottoms. Somebody was talking about one of our stocks today and said he should have sold some of it on a rebound. No. I want to remind you, the very biggest money in the stock market is made by buying and holding small and mid caps that become large caps. And the way you get into those companies is slowly with widely spaced buy prices. Why widely spaced? Because why would you buy something that you're not changing the cost basis on? You buy when something's lower and it's lower enough that you can change your cost basis by adding to your position. And sometimes you buy on the way up when a catalyst hits, you can confirm it. And the market is early in recognizing the catalyst, meaning that it hasn't taken off and broken out yet. Because new highs are where most of the idiot traders start to buy. Well, I'm buying the breakout. Yeah, well, I bought it 50% lower. And that's where you get your margin of safety. Let the idiot traders start to buy it after it hits a new high and wait for that momentum to break. You can count on the idiot traders to give you opportunities on the downside to buy and opportunities on the upside to sell. Why? Because the IRS proves year after year after year that around 80% of traders lose. Why? Because they don't know what the hell they're doing. They're trying to get rich quick. Sure, 1 in 100 does, maybe 2 in 100 even. But 80% of traders, according to their tax returns, lose year in and year out. It is rare. Get it? Rare. It is rare investing that somebody like Shooter keeps beating the market. You just head on over to fundamental trends if you really want to trade. But for most of you, 4 out of 5 of you, scale in slow, carry more small and mid caps than you're used to, and only buy the large caps on big correlated corrections like we're getting now. I probably have to correct this chart too, because this probably comes all the way down here to this one. In fact, we can do that right now, right there. See the quantitative data? See the spot where it jitterbugged? Right there, actually. It'll be right in there somewhere. Oh, that point right there where it got rejected is about right. But I think we should not overcompensate just in case this market decides wants to do something a little different, just in case it decides it wants to throw you off, which is what the market does, right? Market looks for ways to throw you off. So I'm bringing down the base case just a little bit. I know Shooter did too. I want to say his said 336 or something. But, just lowering the top of my base case a little bit. Again, you shouldn't own the S&P 500. But it's instructive in letting you know there's a lot of large cap companies that are crap. That's why it comes down. If the Fed screws up in November, then Armageddon zombie apocalypse is in play. I'll write a whole article on the Armageddon zombie apocalypse because I want that in a headline. All right. Have a good day. Weather is still nice. Keep enjoying it. Don't be in a hurry to buy. And if you own the S&P 500, sell it. Easiest way to raise cash, whether that's your 401k or in an account you have. And if you own old man stocks in the S&P 500, sell them. That's all I can tell you. If they're no growth and capex intensive, basically want to keep the stocks that are in QQQ, but almost nothing of what's left of S&P. It's pretty much that easy. Or if you own S&P and you want to stay in the stock market, just switch to QQQ or IETC, which is the other more broader based fund that we use that basically tracks QQQ, but in a more diversified way. All right. Have a good day.